So yeah, sorry, Seema, take it away.
So James, let's start at the beginning of the Tory leadership campaign. Liz Truss tried to do a Boris Johnson in a different way, implicitly condemning 12 years of Tory rule and declaring herself the change candidate. This included jettisoning the Osborne-era idea of balanced budgets. It makes for a very heated Tory contest, right?
Yes, that's. I mean, it was a bit of a weird. Obviously, it was a strange summer for lots of reasons. It was particularly strange in terms of the Tory leadership contest. The division that became quite stark between Rishi Sunak and Liz Truss was precisely on this question. Now, I mean, frankly, when Rishi Sunak said that Liz Truss's plans to basically push through a load of tax cuts without also making a load of spending cuts on the other side, in other words, to just borrow a great deal of money to jam through her preferred program of tax cuts. When Sunak argued that this would crash the pound and would lead to a massive increase in government borrowing costs and basically be unsustainable, I think, in fairness to him, he's been completely vindicated on this point, as have various other people who pointed out that this was unlikely to be a particularly wise course of action. The bit that's also been thrown into this, of course, was the immediate promise, which is something that Liz Truss didn't talk about during the election campaign, of what they are currently claiming. The government is currently saying is about £150 billion, an extraordinary amount of money, on supporting, I'll say this, on capping the price that people have to pay more or less for the next 2 years on their energy bills. And given that the Prime Minister herself has been a bit confused about what this actually amounts to, it does work out as a sort of cap per unit cost for people, so that the typical household will be paying no more than £2,500. That's a slightly constructed figure. You could, of course, find yourself paying a lot more than that. But broadly speaking, energy bills have been capped for 2 years at the extraordinary large cost of £150 billion. 2 years, by the way, gets you to the next election. I don't think there's any other reason that they picked this length of time. And it's also, I mean, to put it in context, the total cost of the furlough scheme was £70 billion. So it's just about double the cost of furlough during coronavirus they expect to spend on this. It's also, I would say, I mean, look, Labour suggested the idea of a limited period cap, a more limited period cap of 6 months or so, which to me seems pretty sensible. Like, clearly the system that we have, the privatized system we have, where price rises were communicated very rapidly through the existing Ofgem price cap to individual households, without very much sort of restraint, was clearly just proving disastrous for people, absolutely disastrous. So a limited pause to try and work out what a better system would be and try and make things work a little bit better for most people. And there's a number of proposals that come forward on how you might change that tariff system would make sense. 2 years doing this. And bear in mind that a large part of this cost is that Britain has to buy 50% or thereabouts of the gas it uses has to come from imports, primarily from Norway. And then I think the next biggest is Netherlands. And then after that, you're into liquefied natural gas in places like Qatar, small amounts coming from America now. So you have to import this, which means that the value of your currency that you're using to try and exchange to buy those imports really matters. So if the value of the pound drops, all of this looks more expensive. In other words, you're creating, through this sort of institution of borrowing a large amount of money to try and pay for all of this, if you're exposed to the currency risk on top, you're also exposing the government to more liabilities and more borrowing in the future. So it all looks very unstable. So that was the bit that wasn't announced during the leadership campaign. Liz Truss did say she was going to do this very shortly before it was announced that the Queen had died, and then there was sort of 10 days of mourning and everything froze. And then more or less straight after that, and I noticed Kwasi Kwarteng was trying to use this as an excuse, which struck me as a politically brave, you might say, decision, but they didn't have much time after the end of the sort of mourning period to do their mini budget properly, and that's why perhaps things weren't as good as they might have been. So blame the dead Queen for your own sort of mistakes is a bold approach to sort of crisis management. But anyway, so they had actually pre-announced that part of it, but not in the leadership campaign. The NICs, the National Insurance contribution cut, they'd also pre-announced. They had pre-announced the corporation tax cut. This is not a cut, actually. It's a freezing the increase that Rishi Sunak had put in place for coming in for next year, which is expected to raise, or was expected to raise, about £18 billion. So it's a really significant amount of money from that. That was pre-announced. The bit that Kwasi Kwarteng threw in on top, and I think this is probably the trigger for the pound. Well, you can see it's a trigger because you can see as soon as he said it, the pound just crashes. The bit that he threw in on top as a nice surprise for at least, well, people earning over £150,000 a year, I suppose, was the 45p tax cut, a relatively small amount of money. I mean, 2.3 billion is the Treasury costing. Depending on how much credence you give to the idea that people radically change their behaviour, other estimates come in at about £6 billion, but the Treasury say about 2.3 billion for that. Fairly small part of it, but that's what triggered the crash. The other bits, of course, to include in this is the really bizarre and reckless way they decided to enter this mini budget by saying, okay, we're not going to publish any forecasts from the Office of Budget Responsibility. I mean, fairly obviously, because the forecast would not look too good, like the claimed amount of growth down the line, the OBR is almost certainly not going to say will happen. It will just show loads and loads of extra borrowing. And then to sort of add on top of this was, and this is a very peculiar decision, was to sack Tom Scholar, who was a permanent secretary at the Treasury. Now, you know, there's been a lot of sort of saying how terrible that we get rid of Tom Scholar. And personally, I'd have significant disagreements with him. He's one of the architects of austerity in this country. But nonetheless, if you're going to go into quite a significant shift in your fiscal position and change to what the government's doing, it's a good idea to try and calm people down a bit and to sort of suggest that, you know, there's at least a few people around who might know what's going on. So you'd want to keep him there. People might have seen John McDonnell's piece in The Guardian during the week where he said, you know, we would anticipate working well with the civil servants because that's how it's supposed to work. And that we signalled as a Labour Party very, very long way in advance of the election or any possible budget, what our fiscal position would be, how much we expected to borrow. And you do all of this because what you do not want to do is end up with precisely what happened, which is that you basically just frighten people who trade currencies. And I say frighten, you don't want to humanize it too much. You sort of reveal a weakness, and a bunch of people speculating on the pound can make money out of it when it crashes, and they have done. That was the first part of it. So this was just very stupidly set up, I think. There's basic sort of economic management that Kwasi Kwarteng, the people around him, just got wrong, right? If you're going to do something radical, you have to kind of prepare the ground properly and then move into it. That's one part of it. The other bit, I suppose, I wanted to just quickly touch on is then what happens after this, just immediately after this, because it's quite an important part of why things went so badly wrong. Obviously, the pound crashing as soon as you sit down, before you sit down, as Chancellor of the Exchequer is not necessarily something you want. The feedback from that, because we're a country that has to import so much, is that this is going to increase inflation. The energy price cap by itself would get rid of inflation, or part of inflation, right? Reduce the rate of inflation because you're paying less for gas than you might anticipate. Estimates on that are around about 4% off the measure of inflation that we use, so it's substantial. The fall in the value of the pound immediately starts to put inflation back up again because the price of all these imports starts to go up, and we import half the gas we buy, we import half the food we buy and consume. You can carry on like this for a long period of time. We're a big importer, so the value of the pound really matters. So that feeds into inflation, that feeds into the cost of living crisis. First round. The second round is that Kwasi Kwarteng then pops up on Sunday morning programs to say, well, we're actually going to introduce even more tax cuts on top of this. So this huge lump of extra borrowing, £45 billion, that they've just sort of thrown out there, including this surprise element on top, he was then doubling down on. And then on Monday morning, the Bank of England, rather, stony-faced, it's always a bit stony-faced, it's a central bank, had to announce that they were introducing a sort of £65 billion support line for British government bonds in order to, as it turns out, stop what seems to be a whole load of pension funds going insolvent. I can talk a little bit more on that one, Luke. I don't know if you wanted to move on to the next question on your list, or should I just go through that?
Yeah, I mean, we can come back to that in a second, but I'm glad you started with the energy, the global energy commodity price crisis, because that, of course, has in some ways inevitably gone to the political background in all of the entirely justified arguments about taxes and spending, because this is such a huge handout for the rich that completely politically went down like a lead balloon. I was
Yeah.
just wondering, there is this argument that global commodity prices might be peaking. I don't think you agree with it, so I thought I'd throw it in as a question. At the moment, gas prices are falling. That there's Chinese growth figures are really, really low. And so the argument is basically that the Tories and any government that is in power might get lucky here, which is basically that there's going to be a depression that takes away a lot of that inflationary pressure by reducing the demand for oil and gas. And that might happen faster than we expect. So I wondered what you thought about that.
Yeah, a couple of things. I mean, it could happen. I think inflation probably will come down over for Britain and other large developed economies over the next sort of 6 months or so, as a result, mostly of falling energy prices. And part of that, I mean, there's a very major uncertainty on this, which is like what happens with Russia and with the invasion of Ukraine and actions that various governments might take there. So that's a huge uncertainty on it, which is way beyond sort of conventional economics, but it's sitting there and could disrupt things quite substantially. It will probably come down a bit as a result of falling energy prices, and I think oil prices will go the same way. The news from China in particular is that this is an economy now looking quite shaky in terms of continued growth. Now, any number of times in the last sort of 15 years, you've been able to say, oh, China's suddenly looking a bit shaky, and it really hasn't actually made very much difference. There is more concern now that the sort of property bubble that's built up and been somewhat encouraged over the last at least 10 years really, is starting to sort of reach its limits, and there's a wave of bankruptcies expected. And with 20% of Chinese GDP dependent on construction, it's really heavily skewed like this, the construction and property, this has a huge impact on the economy as a whole, and therefore on the global economy, because it's the second largest economy on the planet. You then throw in also the Federal Reserve jamming up interest rates. There is significant pressure on the Federal Reserve now, I think, to sort of ease off on this, but actually the aim of you doing that as a central bank is, to be blunt, is to try and induce something like a recession, that you kind of want the economy to slow down. You sort of want more unemployment. You want all these things to happen to reduce demand, reduce that pressure, as you would see it as a central bank, on prices rising. And as a result, you can sort of pull back in inflation a bit. That's the theory there. So that will start to have some impact on commodity demands. The bit that's going to push inflation back up again, or it's going to counteract that, is I think what's happening to food prices, which are continuing to really, really rise. And that is a more concerning thing, because I think you are starting to see the long-term factors there, which is basically climate change. Like extreme weather events keep happening and keep damaging crop production. Now, this year we've also had the huge damage to exports from the two largest grain exporters and fertilizer exporters on the planet, which is Russia and Ukraine. But you've also got continually this impact on agriculture of extreme weather events, whether it's a frost in Brazil, whether it's, I'm trying to think, it was a plague of locusts in South Africa early in the year, frost in Canada damaging grain harvests there. You can sort of carry on. I mean, the Department for Environment and Food and Department for, what do they call it? Environment, Food and Rural Affairs in Britain. It's got these slightly alarming forecasts for the damage done to British food output, particularly fruit, over this year by extreme weather. I mean, it's all getting hit. And then, of course, you've got the problems of obtaining fertilizers for next year's harvest. So stack all this up, and it starts to look like there's quite a severe amount of pressure on the food system, which means that food prices carry on rising. So your gas bill may well come down, or at least, if it's capped, it will look better than it did. Food prices are going to carry on rising. Overall inflation will come down a bit, you'd have thought, but it's still not going to feel particularly good at that point in time. So that I think is where we've got to here. Obviously, and I should also say, none of this looks great. Like if you're saying inflation will come down because we're going to have a global recession, that's not a good place to be, right? That's not a particularly happy point in time. But it looks like at least reasonably likely over the next sort of 3, 4, 5, 6 months.
Thanks so much, James. I mean, that does make me feel very pessimistic about my increasing Tesco food shop bill every week, which just seems to be going madly up and up every time I return there. You already touched a bit on the market reaction. Could you tell us a bit more about why investor confidence dropped so quickly and so sharply, because I think that's something that might have been quite surprising to a lot of us. And also, do you feel a bit vindicated as a advisor to John McDonnell and John McDonnell's approach of fiscal caution when he was Shadow Chancellor?
Okay, I mean, I think the issue here is the reason it changed so quickly. It's a bit like you get this with particularly financial markets. A great deal of what happens in any, particularly if you're trading things that, like, it's not necessarily things that physically exist. Like at some point in time, okay, if you trade oil, the oil will get delivered. But if you trade contracts to deliver that oil in the future, those contracts don't really exist. It's just a financial contract. It's an options contract, as they're called. And there's other more complicated versions of that. So if you're trading things that don't really exist, a lot of what you're doing will depend on beliefs about what everybody else is doing. And because it's based on beliefs, things can change rapidly. So in the case of what happened over last week, it's kind of like that moment where Wile E. Coyote rushes off a cliff, chasing Roadrunner, and for as long as he doesn't look down, right, the belief that the cliff hasn't arrived yet sustains him. As soon as he looks down, he falls. And there's a degree to which this is what's kind of happening in financial markets, that suddenly the belief disappears and you fall. Now the question then is, okay, why have we run out of ground? And that's the big unpleasant thing here, which is that really the British economy, I mean, look, everywhere doesn't look great at the minute. That's sort of true. The British economy looks particularly bad because it's actually just been a very low growth, very low productivity growth, low investment, low wage growth, really low wage growth, highly indebted and highly import dependent economy for a long period of time. And it's been able to sustain itself mostly because really has institutions primarily like the Bank of England, which are very big, very well established. I mean, Bank of England's the second oldest central bank on the planet, very well trusted by people, that, as you've seen over the last 10 years, longer now, has continually been able to step in and kind of prop everything up. So when the financial crisis happens in 2008-9, it's the Bank of England that launches quantitative easing in early 2009 to sort of keep the show on the road. They fire up their electronic printing presses, in effect. When the Brexit vote happens and the entire kind of political leadership of the country disappears for a bit, it's Mark Carney at the Bank of England who says, it's all going to be fine, we'll be there to sort of keep a lid on anything. During coronavirus, exceptional amounts of expenditure that government's making. It's the Bank of England that, they don't like to talk about this, but basically finances this directly by printing money, electronic money, but that's how coronavirus spending is financed. And you can do all this because everyone says, well, it's the Bank of England and we trust it and we know it can be well managed. We've been there for a long period of time. Britain's a big economy. That's all good. You saw this again on the Monday straight after the budget, where it was the Bank of England that had to intervene in bond markets, completely reversing its earlier policy of not buying government bonds, in other words, not trying to prop up the bond market, but actually selling government bonds. So it completely reversed that in order to intervene. Now, this it's good to have this institution that can do that, that's trusted like this. There are limits to what that can do. And once you actually just have a fundamentally weak economy and you have a government that seemingly acts with no real regard to that fundamental weakness, you're leaning very heavily on people having some faith in your institutions. And bear in mind, there are other smaller institutions, but still important. The Office Budget Responsibility over the last 10 years has established itself as a reasonably sort of independent voice that can talk about what the government is doing. If you say we're going to ignore it, that's kind of shaking that thing, right? So you're damaging the institutional credibility at this point in time. If you're in a weak economy, that's bad, and things can look quite violent and dramatic all at once. In the case of specifically what the Bank of England did on Monday was that you had, not just in Britain, but pension funds across the world have been doing this, that because we'd had such low interest rates for a long period of time, and pension funds, they need a safe asset that's going to play out a return for a long period of time. They need to invest in things that are safe and secure. They really like government bonds because they're very safe, particularly if it's a British government bond or an American government bond. The government's going to be there and it's always going to pay out. It's not going to turn around and say we can't pay anymore. So it's safe. But if it's making no money, if interest rates are low, that's no good if you have to pay pensions. So what they've increasingly done is find ways to try and manage that low interest rate situation. We're using, in this case, something called liability-driven investment, which is a sort of bit of jargon, but basically involves setting up some fairly complicated financial instruments to try and increase the amount of return you can get for any amount of risk that you're taking on the market, basically. Critically, this depends on no sudden movements in interest rates. So if interest rates change suddenly, the entire thing is thrown into chaos. And that's why the Bank of England had to step in, because there was a risk of many pension funds in Britain being exposed to these quite complicated, quite leveraged ways of managing their funds, that suddenly they had to make very, very large payments to the people they'd written the derivatives, these complex financial instruments with. They had to pay large amounts of money to them, and there was a risk of being insolvent. So this is a shaky situation all around. And to have to continually lean on the Bank of England to step in is creating a risk that at some point everyone will not only have not much faith in the British government, which I think is kind of what's happening at the minute. That's why the borrowing costs of this government have risen compared to what they were before the mini budget. Even if things have calmed down a bit, it still costs more for the government to borrow. There's also a risk, I think, to the credibility of the Bank of England and other fundamental institutions. So that's the bit there. In terms of indication, well, yeah, I suppose so. I mean, it's been a rather terrible demonstration of why, if you want to do something radical, and the Truss government wants to do something radical, you have to kind of manage. You can't sort of pretend global capitalism doesn't exist, or possibly in the case of Truss and Kwarteng that everybody will just sign up to it. They'll just agree with your schemes. It's the bankers who'll benefit the most from the tax cuts, so they'll just be, okay, that's fine. If you saw comments on like the Financial Times, there was a lot of people saying, why are you giving me £4,000? I'd rather have public services that work properly. Well, I think there's quite a genuine sentiment along those lines. The IMF stepping in and saying this is a bad idea, look what it's doing to inequality, is quite an interesting moment. This is the key institution of neoliberalism is turning around and saying, actually, we really don't agree with trickle down. You know, this is there's a shift in how the world operates, and the British government is trying to act as an outlier relative to the American government, for instance. You have Biden saying trickle down doesn't work. A couple of times he said this. The British government's an outlier. It's in a weak economy. It's doing some risky things, so it's going to get attacked. And that's kind of what happened.
It's really great to hear such a clear explanation of the relationship between pensions and bonds and the Bank of England intervention. I think a bit like the 2008 financial crisis, I suspect members of the public, like myself, watching this event are not so different to some of the policymakers managing these derivative and financial products, that you suddenly have to go get yourself clued up on these relationships. And I don't think that that's entirely changed. I wanted to ask you about the financial contagion potentials. One of the interesting things we saw, it seems to have cooled now for the time being, but one of the interesting things we saw was the Federal Reserve and the European Central Bank getting very concerned about what Britain's doing, because of obviously this is a highly financialized economy. It's one of the major centers of global finance, and it raises this kind of interdependence question. One way of thinking about what the very radical program of the Truss government, just not the kind of radical that we're into, is like it's this culmination of Brexit ideology that believes in fantastic reasoning, right? Or fantastical reasoning. And but immediately we saw that what you can have this sort of try to have this national sovereignty radical intervention, if you like, but actually it's dependent, or would be dependent, on cooperation between central banks, cooperation between the US Federal Reserve and the European central banks. And so that's a long way of getting to the question, which is, is at the background here, there's a global depression unfolding. Okay, the British government has done something stupid, but the world economy itself is not in good shape. And, could this have been a tipping point, or might this still be a tipping point to a global financial crisis Mark II?
Yeah. No, it's a very good question. And this point about interdependence is critical, because Britain, as you say, is a very financialized economy. In other words, there's just an enormous amount of sort of financial products that are traded here, that are owned here, that other people in the rest of the world come and trade here and take shares out of, and that because for many reasons, because Britain fundamentally is a very big importer, you end up with a lot of exposure to the rest of the world. You're relying a great deal on people in the rest of the world lending institutions in Britain a great deal of money. So if something shakes here, it exposes the other side of all those relationships. That if you turn around, if you borrow money off someone and say, oh, I can't pay you anymore, I mean, that's quite bad for you. And you may have reasons that you're in some terrible situation when you can't repay it, but it's pretty bad for whoever you borrowed off because they're not getting the money. That's the risk. And that's the kind of fundamental financial risk that you create with these sets of relationships. So because Britain's so big, if it does anything kind of mad, there is a chance that thing spills over elsewhere, and it can act as the trigger for all these other instabilities and weaknesses in the rest of the world economy. The big picture here, I think, the most important part of the big picture, there's several things going on. The one to grasp most immediately is that we're reaching the end. We're clearly at the end of this period of time where interest rates have been very, very low. And that is more than a decade, really, since the financial crisis, where central banks around the world have jammed interest rates that they can try and control as low as possible. They've done billions of pounds worth and yen's worth and euros worth and dollars worth of quantitative easings. They've flooded financial markets with money. So money's been incredibly cheap, easy to get hold of. And because you've done this for so long, we've ended up with a world where everybody's adapted to a situation where everything is quite cheap if you're dealing money, right? So pension funds who would prefer a higher rate of return on their safe assets that they're trying to invest in have gone out and done lots of sort of slightly complicated financial derivatives and financial engineering to try and generate that higher rate of return. That's what blew up on Monday last week. That's what's also looking shaky in the US, because it's exactly the same thing they've done over there. They're also in a low interest rate world. They have to try and cope with this. It's not quite like 2008. I don't think it's doing something as obviously stupid as setting up a collateralized debt obligation or something like that. If you watch The Big Short, I think it's probably the best quick explanation of what happened there. This was deliberately making risk happen. In case of pension funds, it's actually just more like trying to get a return so you can pay a pension. But there's an instability there. And once interest rates start to rise, particularly if they go up really rapidly, like happened in Britain, a world that is built, a financial world that's built around low interest rates, is suddenly going to be exposed to the risks that come from higher interest rates. That's the kind of fundamental problem here. That applies in America. That applies in the ECB. There's a good piece by Ambrose Evans Pritchard, who is always good for the doom mongering in the Telegraph, just been published about the situation the ECB's found itself in, and that, this isn't just a British problem. This is no time for Schadenfreude for anybody else. There's many things that can go wrong right across the world there. But it's that point about interdependency. So there probably was at some point last week at least a reasonable chance, if not a very high chance, that what the British government was doing would actually be the trigger for a wider financial crisis, which would be, I'd say hilarious. Obviously, it's not really, but it would kind of even more, add to the merriment of the situation, that not only had you managed to tank the pound and the British economy, you managed to sort of drag everybody else down behind it because of the sets of interdependencies that are built up. But that's a fundamental one. We're now in a world where interest rates are going to be higher. So all the people trading financial products and building institutions around the idea that interest rates are low this is likely to expose some of the weaknesses and some of the problems that people who are relying on low interest rates are going to be exposed to higher interest rates. They won't be able to pay them. It's a fundamental problem. You're in a world where inflation is going to be higher, so it's just kind of harder to do business. And you're probably in a world where growth is going to be somewhat lower than we've been used to as well. Not that growth has been particularly impressive, but once you start having major part of global growth for the last 12 years, which is China, looking much shakier and slower, global growth is going to be much shakier and slower. So the whole world economy is kind of slowing down and looking a lot creakier. And that's the point where relatively small events, including on a global scale, a kind of daft budget by Britain, can tip things over the edge somewhere else.
Thanks so much, James. And I have watched The Big Short. It was a very well-made movie, but I feel like watching the news now is like watching a dark comedy version of it, but really fast-paced in real time. I was just wondering, you spoke about the Bank of England intervention, but do you think it's going to work? And isn't printing money to effectively prop up the currency potentially bad news?
What's happened, printing money, some people get very upset when you talk about printing money, but it's the quickest way to describe what quantitative easing is, right? The Bank of England, like any central bank, like any bank actually, can issue new money. It's just one of the things that banks can do. And the central bank in particular can issue what is supposed to be the highest quality money you can get in any particular currency, right? You can, if you're an institution with a bank account at the Bank of England, this is the best kind of pounds you can get. These are the most robust pounds you can get because it's a claim on the Bank of England itself. If you have paper notes, then the little thing where it says, "I promise to pay the bearer," is a small representation of that. But bear in mind, notes and coins is about 3% of all the money in circulation in an economy like Britain, so it's a small part of it. So that's what the Bank of England can do. It can just issue more of this money. And what we've seen since early 2009 is around about March 2009, they have used something called quantitative easing, where they issue more money and then buy up government bonds, mostly government bonds. And that was a way of trying to support. There's several reasons why they said they were doing it. It was a way at the time trying to support economic activity in general by keeping interest rates low, helping keep interest rates low, and also getting more money into the system, because everyone was panicking in 2009 about, nobody had any money, nobody wanted to lend any money. So you just, as a big financial institution, you just sit there and don't let any money out. There's no money going around your financial system, the whole thing freezes up and your recession just gets worse and worse. So that was the plan. We ended up doing this 10 years, which is a real indicator, more than 10 years, which is a real indicator of just how badly wrong things were going, but it becomes an accepted part of the furniture there. What the Bank of England has recently started to do is say, okay, we now have higher inflation. Now, frankly, and they admit this is inflation not really coming from what's happening in Britain. It's coming from big global events. Invasion of Ukraine, most obvious sort of big global event. You then got also just rising commodity prices in general, I think because of environmental problems, extreme weather, resource depletion, all this sort of stuff. So it's big external things that are happening. Nonetheless, the Bank of England has responded to this by saying, if we push up interest rates, we can clamp down demand domestically, and that should, in our little model of the world, start to bring down inflation. At the same time, instead of pumping more money into the economy through quantitative easing, we can suck money out through quantitative tightening, which is a reverse process. So instead of putting money out and buying government bonds, you sell government bonds and you take money back in. So you sort of suck the money that you pumped into the economy back in. Now, what happened on Monday is that was the plan the bank had, and they were going to do this for months and years into the future. They immediately had to throw that into reverse. They immediately have to throw that into reverse and say, we are now going to go and buy bonds because all these pension funds are exposed. So we have to support the market. We have to support interest rates, that sort of thing. It's bad for a central bank to have to do these sudden reverses. And it's bad if it's having to do one thing, which is we must preserve financial stability. We don't want pension funds to collapse, which is part of what a central bank is supposed to do. It's meant to keep everything stable and secure, and the whole system is just going to carry on running quite happily. But it's also supposed to try and keep inflation down. So you've now got something that's very inconsistent. You're doing something which is financial stability over here, but it might damage your claims about we want to keep inflation down over there. So the Bank of England's in an awkward place, I'd say. That's why they said they would only do this for 13 days. Because if you say it's indefinite, you're indefinitely sustaining this weird contradiction. And weird contradictions is the sort of thing that attracts speculators and people who are going to try and short the pound and lots of other sort of things of this nature. So they're going to do that for 13 days. What you have to hope is at the end of this 11 days, on the 13th of October, no, it's 13 days, the 13th of October, that pension funds will have sorted themselves out and everything's going to be fine. It looks like actually things will be reasonably calm by that point, at least as far as this bit of the system goes. But it is a bit of a problem when you start having central banks having to behave like this, and probably other central banks might find themselves doing something similar. So that's another sort of additional instability in the system, that you have now central banks, not just normal banks, normal financial institutions subject to sort of pressures and contradictions and potential speculative attacks. You've got this issue where potentially central banks, sort of core institutions for any major economies, core institutions, central bank, also going to be subject to those sort of speculative attacks.
So let's move to the politics of it, because we've covered the macroeconomics. I mean, the politics of it for the Tories, to cut a long story short, have been absolutely catastrophic, and predictably so. I mean, there was that YouGov poll that showed a 33-point Labour lead. It's not an outlier. There's a collection of polls that show double-digit 20-point leads, 33-point leads, etc. So it's been an absolute calamity. And of course, it's a real sign of how the Tories, or at least one part of the Tories, the part that's now in power, not Boris Johnson, who was corrupt, who was opportunist, he was all the things that we don't like about him, but he could certainly read the British electorate, he could read the mood, and was very effective at responding more or less to what the median voter thinks. This lot, it's been a complete calamity for them. This must create opportunities for the left. So how should we be responding to this crisis of Toryism? And, you will have seen everyone on the call has probably seen the stories of the very, very public infighting at Tory party conference today. Seem to be intent on making the Labour Party look like a positively harmonious and faction-free organisation. So James, what do we do?
That's a big question. I think and one for more discussion. I'm always sort of happier talking about the economics and the sort of slightly more, because the politics is in many ways much more speculative. But I think there's a couple of things from that. The first one is that the comparison people have made. I'm looking around. Probably some of you, most of you on this call will remember Black Wednesday, or at least know of Black Wednesday back in 1992, when the Tories, in different circumstances, but actually somewhat similar, when there's at the heart of it was an inconsistency in their stated objectives with what financial markets thought they could actually achieve. And there's something like that going on here. When the government said it would try and maintain a very high value of the pound to stay inside the exchange rate mechanism that precursed to the euro, this was not believed by people trading the pound because it implied very high rates of interest. Bank of England tried to stick to this plan to keep the pound at a high value by raising interest rates when the pound was subject to speculative attack, to people really selling the pound in vast numbers. By the end of the day, this didn't work, and they just abandoned the exchange rate mechanism, cut interest rates. That was that. Now, it took 18 years really for the Tories' economic credibility to recover sufficiently. And it took another major global financial crisis before they were in with a shout of winning again. It really devastated them. I don't want to overstate that, by the way. There's a peculiarity that comes out of what happened back then, which is actually, relatively speaking, Black Wednesday was quite good for the British economy. In a world economy that was growing, a reduction in the value of the pound was one of the factors at the time that helped spark up the boom and the recovery from the recession. So I think on the polling, the Tories actually recovered a lot of their lost ground on economic credibility. This time round, that isn't going to happen. We're not looking at a world economy that's growing, and that if the value of the pound falls, it's not like that makes your exports cheaper and everybody wants to buy them. If everybody else is in a recession, nobody wants to buy your exports, but you have to pay more for imports. That's what the falling value of the pound means at this point in time, in a world of instability and the rest of it. So this isn't going to get better for them. And it feels like a more fundamental, because it was more obviously the triggers for it, and the story people are going to have on it is the Tories tried to give a load of money to their rich friends, and this caused a massive market panic. And that's just the most stupid thing you could possibly do. Why would they do this? So they're doing something wildly unpopular that also completely trashed everything. So to me, it looks like this is going to be extremely hard for them to get out of for a very long period of time. And it's very hard to see in the next 2 years how they recover to win the election, or even get to the point of a hung parliament or something. Having said that, if you look at the last 2 years, I wouldn't want to, who knows what wild things might happen between now and January 2025 if they cling on to the absolute last moment, might happen. So that's kind of trash them there. Now, that means Labour is likely to win. I think that changes part of what we might want to think about if you're on the left in the Labour Party or not, because this is now going to be a Labour government which, coming out of conference, actually had some solid commitments to sort of decent social democratic policy. Like the slogan of conference was a fairer, greener future. This is good. This is better than we love Britain, here's a flag, or whatever. There's some of the other slightly superficial options might have been available there. That Keir Starmer made a big pledge to set up a publicly owned renewable generator. This is a big step for his Labour Party. It's not relative necessarily to what was happening under Jeremy Corbyn, but it's a big step. The National Wealth Fund, which actually was never there, should have been, but for various reasons it was never in the Corbyn programme. Industrial strategy, pledges on increasing some taxes for the rich, 45p obviously restored. Well, Tories doing themselves, but also some additional taxes on the rich. So it's actually a good, solid social democratic programme with lots of sort of meaty pledges that are coming through there. The challenge at this point in time is that Labour might win. It's not implausible. The polling says this, might win a 1997 style majority or even bigger. I mean, the hilarious seat calculation that the Tories on 65 seats was, you know, these things are slightly farcical, but you can run the computer and it'll try and tell you how many seats they get. So 1997 style victory is not implausible as of this point in time. I'm not convinced it'll be quite like that when we get to 2024, 2025. But 1997, Blair arrives in very, very benign economic circumstances globally and nationally. The squandering of Labour's majority is a sort of great tragedy of that period of time. Like, what did they actually do? They had this incredible opportunity in the most favourable circumstances possible, and they wasted it. If Starmer wins, it'll be a big majority, so expectations will be high. People will want a change, but it'll be in very unfavourable economic circumstances, no doubt worse than we actually have at this point in time. It will cost more for the government to borrow than it used to. Inflation is still going to be high. We may already have seen, you know, another round of austerity and spending cuts and all the rest of it, which the government will be expected to try and restore. If it costs more to borrow, if you can't lean on the Bank of England to do as much as you used to, and expectations are high, you have very little room for manoeuvre as a government. And I think to avoid, therefore, the more small c conservative forces and elements inside the Labour Party saying, well, things are difficult, so we have to trim our programme down to what we can sneak through without actually doing very much because it's all very expensive and complicated. I think we need to say, actually, this is a time for more radicalism, to be bolder than you would have been. And in particular, and this strikes me as the most obvious argument to try and hammer, this is when we have to start talking seriously about taxing wealth and taxing the super rich. Like this requires serious action. It requires a programme now laid out. These are the taxes. This is how much we're going to raise. This is what we're going to spend it on. They've done bits of this. In fairness, they've just done nothing like enough. When you think about how much you're going to have to spend to get the NHS back on its feet, when you think of potentially having to restore, you know, £45 billion worth of cuts that the government are now sort of contemplating, these are huge sums of money, and we can't borrow as much as we used to because it's too expensive, and you can't get the Bank of England to just print money because that's creating all sorts of dangers in itself. The pound's falling in value, all sorts. So you're going to have to tax the rich. So the argument for the left for the next few years, I think, is we need more radical action. We need more bolder policies from this Labour government because the challenges are going to be very, very significant. And we need a credible programme on how you're going to pay for all these big public spending demands that we're going to want to, just to get back to, you know, public services that actually work, an NHS that just works. You're not even, you know, super all singing, dancing. Just to put it back in its feet, it's going to be expensive. So that I think is where the economic argument for the left needs to land.
Thanks, James, for that call to bold action.